Everybody, welcome to a discussion on this topic, that is hedge accounting. Friends, this topic assumes significant importance again within the gamut of the bigger topic, which is financial instruments, and as we understand the topic hedge accounting, so it's all about understanding the accounting requirements for the hedging practices that are adopted by companies, right? Before we get into the accounting side of it, let's try to spend some time together on understanding what is hedging, how companies achieve hedging, why would they want to do hedging, and what is the purpose of hedging per se. Okay, let's take some examples around that to understand the terminology better, and then see to it if we can really make some connect with these scenarios there. Okay, let us say that there is a company X, which is an airlines company. Okay, it knows for sure how many flights it operates per day, basic information, right? It also knows what is the distance it covers per day based on the routes of those flights, and it also understands average fuel consumption that it will have on a daily basis for such kind of flights, right? Taking it a step beyond, if I say that the company needs to purchase fuel, I'm referring to jet fuel, right? Naturally, the biggest concern for this company is that if, for example, the price of crude changes, I would still use the term increases, right? So it would have obviously a challenge, because its cost of purchase of the fuel will increase as well. So the crude oil prices automatically impact the jet fuel prices also, okay, in the same direction, of course. Now if I say that this company understands its average fuel consumption on a daily basis, it would certainly be able to project average fuel consumption for any future period, right? Based on its forecasts on how many sectors does it want to operate in, for how many years will it do that, if there is any expansion plans and stuff like that, right? So the one concern or one big risk that this company has is that there's a lot of dependency on the crude oil price, right? So it would certainly want to, or it would wish to, protect itself from an increase in fuel prices. Of course, that is uncertain, right? So in a way, it might enter into an arrangement with an oil producer to purchase oil in future at predetermined rates, Logical enough, right? So when I say I'm looking at this kind of an arrangement, in a way I'm trying to fix the price of oil because there is a risk that the oil prices may increase. Sounds okay? Yeah. Of course, it could be a wrong decision altogether, that if I'm fixing the price of oil at, let us say, so let's say this fixation is done at maybe $80 per barrel, right? Please bear it in mind, for the sake of convenience, we are still talking about the term of jet fuel, but the contracts might only be available for the crude oil in the derivatives market in general. Okay, so when I say that I'm looking at fixing the price of the oil, I'm somewhere saying that, okay, if I'm fixing the price of crude, which is easily available for me, accordingly I can manage the price of course jet fuel also, which is my requirement as far as inventory is concerned. Likewise, for the jet fuel itself, I can very well go to the producer and do an arrangement like this, that yes, I'm going to buy these many millions of barrels of oil from you over next 5 years at this specified rate, right? If I do this as an airlines company, as company X, I'm at least ensuring that I do not pay more than this $80 per barrel. Is it okay? Of course, the risk is very different again. If I get into this contract and the oil prices actually go down, I'm bound by this contract to purchase oil at $80 per barrel. Okay, so of course there's a flip side to it. I cannot be expected to be making money out of such contracts. Not in general, although it can be done. Of course, we are still not talking about that. What I'm trying to say is, if I'm getting into this kind of a contract, I'm in a way trying to protect myself from a risk that may arise, and such a process is nothing else but a hedging activity. Okay, yeah. Let's talk about something else further. Let us say that I'm a company XY that has taken a loan of $100 million. Okay, and the loan is available to me at a variable rate. Okay, so let's say we are saying LIBOR plus 3%. Okay, let's say further that the term is 5 years. Okay, and interest is reset every 6 months. Okay, so in a way what I'm trying to say is, on 100 million, every 6 months I'm going to pay LIBOR plus 3%, and this LIBOR is fixed for the next 6 months, and once those 6 months are over, the next LIBOR will be set, pre-decided as per the contract, and if the LIBOR increases, my interest obligations increase as well. If the LIBOR decreases, of course it's a happy news saver. But then if this company XY perceives that, considers that, thinks that if the LIBOR is likely to increase in future, if the LIBOR increases in future, then what it should do? Because in a way it would be exposed to more payments, it would land up making more payments, right? So that is where it might want to get into a interest rates swap okay, where it is obliged to now pay a predetermined fixed rate, right? So this swap would be a floating to fixed swap here. Is it okay? So what I'm trying to look at is, there's a risk here that the interest rates may increase. Are you fine with this idea? Yeah. So again, this is an arrangement, this is again a usual arrangement of hedging or protecting yourself against such kind of financial risks. Is it okay? So we are essentially talking about the hedging activity happening in such kind of scenarios. There could be multiple types of risks that a business is exposed to, depending on its activities, depending on the transaction, depending on the exposure that it has on different sides of the business. So accordingly, the hedging activities also keep on happening, and it's very usual to have for any large business to get into hedging arrangements. Is it okay? So what we are trying to focus now is to understand, if I'm doing hedging, what is it that I'm achieving, right? And then the next question of course comes in, if I'm achieving that or if I'm not achieving that, how do I account for all such transactions? How do I account for this hedging activity? Of course, is it comfortable for us, first of all, right? That is the first step that we want to of course understand with the help of this particular lecture. Okay, let's again try to take up some scenarios and assess how do we do the accounting under hedging. Okay, so there are some terminologies that we want to spend some time understanding, and then probably be able to talk more on how does hedging happen, or how does the hedge accounting happen here. Is it okay? Let us say, for the sake of convenience, I'm saying there is a company X, okay, which is an Indian company. All right, it exports goods worth 100,000 to that's US dollars 100,000 US based customer on 1st of October 2017. All right, and then we are saying that the payment terms are 6 months. Is it okay? Right? So there is a customer which is a US based customer. I'm selling him goods in his currency. Naturally, had I been in a position to sell him goods in INR, then there was no risk for me, because I know that I'm in any case going to receive a fixed amount of, or a fixed unit of currency, which is my own currency as an Indian seller or an Indian exporter. But then the problem is the problem is that I'm not in a position to be able to sell my products to my customer in my currency, but rather his currency. Maybe he does not want to get into the currency risks. Okay, and that is where you start understanding the terminology even better. Here we are saying that today I'm exposed to a a currency fluctuation risk. Today I'm exposed to a currency fluctuation risk. The result would only be known only after 6 months of time, whether this transaction has done better for me or has it gone worse for me. The risk exists. That's the whole idea of talking about hedge accounting. There is a risk. So if I think, or if I perceive, if I believe that the US dollar in future is going to be devalued against INR, that is, the value of the dollar would depreciate as against the INR, that is, the INR will become stronger. It means that I'm perceiving that I will receive lesser amount of INR because that is the currency that I'm doing my accounting into. Okay, so that is the risk. So what I may want to do is I may want to protect myself by getting into an arrangement where I fixed the USD INR rate. Is it okay? Right? So what I'm now looking at is I have an exposure of receivables to the extent of $100,000. Is it okay? Right? So this exposure is resulting into a risk which I want to protect myself against. Right? So here, when I talk about this exposure of receivables, I refer this to as the item that is exposed to risk, right? The element in my balance sheet, for example, in this case, that is exposed to risk, and I name it as the item which needs to be protected or hedged item. Are you fine with that? Yep. Of course, there are different kinds of hedging arrangements, as we were trying to kind of understand it a while ago. And accordingly, there are different types of hedged items that may come into consideration. We'll talk about that, of course, later, but we are still trying to understand the fundamental aspect of hedging, or even talking about hedge accounting briefly here. Okay, so here I'm saying that this is my hedged item. I need to protect myself by getting into an arrangement. So what I do is I want to get into an arrangement where I fix the USD INR rate. So I approach a bank. Let's say there's a bank XY to whom I approach, and I tell the bank, look, I will have $100,000 available to me in 6 months' time. At what rate will you buy these dollars from me at that point in time? Okay, so this agreement, this arrangement, I'm getting into with the bank so that I'm protecting myself, right? So what is happening now? The bank XY may give me a rate about the future. Since it's an agreement between me and the bank, two private parties, and it is not something which is a listed contract or where there are millions of people doing such kind of transaction, on a single platform. So we refer this to as a forward rate under a forward contract or a forward agreement. Okay, right? So when I say that I'm looking at a forward rate, it may so happen the bank tells me, look, 6 months from this date, that is 31st of March 18, I can offer you a rate of 70 rupees. Okay, right? Let us say on the date of sale, this rate is standing at 68 rupees here. All right? Is it okay? Now, effectively, what we are saying here is, what does it imply? That I'm making a sale on 31st of March at 68 rupees per dollar. With this agreement, I'm assured that I will receive 70 rupees per dollar in 6 months of time, which of course means that there is bound to be a profit of 2 rupees from the date of sale at this rate and the realization of money on this date, right? But what is crucial as far as hedge accounting is concerned is to ascertain whether the decision is a good or a bad decision, right? My accounting must be able to reflect that piece very, very clearly, whether this decision is a good decision or a bad decision. And that is the reason why we do hedge accounting. Okay, so if I say that I'm trying to protect something, I name that something as hedged item, and the thing that I use, the arrangement that I get into, the contract that I get into, through which I'm trying to protect my risk, is referred to as a hedging instrument, right? Something that I'm trying to protect is the hedged item. Something with the help of which I'm trying to protect the hedged item is my hedging instrument. Sounds okay? Yeah. So when I have these two things coming in, it can very well happen that the value of my hedged item is getting or becoming low. Of course, the hedging instrument's value will become higher and try to protect me against that risk. Okay, we'll just try to spend some time understanding this piece specifically. What we are saying is, I'm going to use this number, of course, again. So we are saying that my forward contract is 70 rupees per dollar. So what I'm trying to say is, from the date of sale, okay, where my spot rate, where my rate on the date of transaction stands at 68 rupees, if I say that the value of dollar is declining, okay, so let's say it reaches 66 after 1 month, it becomes 64 after 2 months, maybe it falls to rupees 62 on this day, 31st of March 18, right? What we are trying to say is, had I not protected my receivables, yeah, the value of the receivables would have gone to 62. Is it okay? So even with hedge accounting, the value of receivables is still 62. But thanks to the hedging instrument, I will certainly realize 70 on that date. Okay, so ideally speaking, my accounting should be reflecting that yes, I made a great decision. I anticipated, I assessed, I perceived that I have losses in future because of this transaction. So ideally, I'm protecting myself against those potential losses, and accordingly, the hedging instrument saves me from that, right? So that decision has to be reflected in the books there and then. We're going to do that part as well in a minute. But now, if I say that I took a wrong decision. I made a bad decision, right? Which probably means, what if the rate after 1 month had moved from 68 to let's say 70, had gone after 2 months to 72, and eventually at the end of 6 months it goes to 75, right? How do we read this now? The way we should be reading it, and rightly so, is that had I not got into this contract, right, I would have received 75 rupees per dollar. But sorry, with the contract, because I entered into the contract, I can only realize the dollar at 70 rupees per unit. Okay, so in this case, this instrument is becoming more of a liability onto me. This arrangement, this agreement has rather become a burden onto me. Are you fine with that? So according to these changes in the exchange rate, I would be able to determine whether my contract, my hedging instrument is actually becoming an asset to me because I'm realizing more out of that, or is it becoming a liability to me because I probably have done something wrong, or something has wrongly happened because I got into this transaction. Sounds a bit okay? So what we're trying to say is, one, that if my hedged items value is increasing, it is quite likely that the value of hedging instrument will decline, and of course the vice versa. If the value of hedged item starts to decline, the value of hedging instrument would, actually speaking, would offset against that particular change in this value of hedged item, right? My hedge accounting requirements simply talks about one thing, that do the accounting of your hedged item and also do the accounting for your hedging instrument at the same time, right? So that is something that we want to talk about, of course, at this point in time when we discuss the concept of hedge accounting, right? Let's try to even do it a bit further, and then we can try to assess in terms of how does this accounting take place. Okay, I'm just going to use some information around the same scenario that we created just a minute ago, and then see to it how does normally the accounting take place in such kind of scenarios. Okay, let us say that this is my company X, that is an Indian company. There is a date of sale on 1st of October 2017. The value is $100,000. 6 months credit. Okay, the money will be realized on 31st of March 2018. Let us say that exchange rates. Let's try to understand this better. I'm saying that on 1st of October 17, $1 is worth 68 rupees. Okay. On the first reporting date, let's say 31st of December 17, my dollar now goes to maybe 72, and on the date of realization it goes to, let's say, 75. All right, but then what I did, I got into a forward rate here. Okay, now I fixed it at 70, right, with the maturity on 31st of March 18, right? I'm making a sale at 68, but to protect against a possible adverse currency fluctuation, I booked my contract at 70 rupees per dollar, okay, which would expire 6 months from the date of the agreement. Sounds okay? Yeah. Now, let's try to understand the bit on the behavior of these exchange rates. Here you would notice that in 3 months time the dollar rate has increased a bit, right, from 68 rupees per dollar to 70 rupees per dollar. Now there are two things that we need to understand. One is that the dollar is appreciating as against the previous rate, and your tenure is declining from a 6 months period to a 3 months period, right? So there is more certainty. There is a closer understanding or a better understanding of the possible exchange rate, in 3 months now, because there is a shorter duration, right? So if I say I'm making a contract on 1st of October 17, yes, I expect the dollar to increase in value. That is why against 68, somebody is offering to sell me the dollars at 70 rupees. Okay. But then when I reach this date and the dollar is already sitting at 72, there could be a likelihood where I'm able to, let's say, get into this contract at 73. Yeah. What does it mean? I'm saying that if I were to enter into this contract, the contract to sell $100,000 on 31st of March 18, on this date, I would have received 73 rupees per dollar. Is it okay? Yeah. And then finally I'm saying that on the last date, of course, my spot rate or my then rate would also be the rate that the bank would offer me if I rather go to the bank on 31st of March, right? I mean, imagine it like this. I had booked my rates at 70 on 1st of October already. But if I don't book that there, and I rather go to the bank on 31st of March 18 and ask them, guys, I've got $100,000 with me. At what rate are you going to sell me? Are you going to buy these dollars from me? Of course, the spot rate and this forward rate on the same date will exactly be the same. Yeah. What does it mean now? What we are saying is, here, the value of my hedged item is increasing. My receivables, which I booked at 68, they became 72 and eventually 75. However, if you look at your forward rate, if you look at the forward contract, what is this arrangement trying to tell me now? I booked my forward contract on 1st of October 17 at 70. Had I not booked it on this date, 1st of October 17, but on 31st of December 17, I would have received 73 rupees per dollar. Yeah, which means that this contract is becoming a burden to me. This contract is losing its value. It is rather going negative. So against a positive of 72 minus 68, that is 4, I'm getting a negative of 3 here, which is 73 minus 70. Okay. Moving a bit farther, we are saying, had I not done this contract on 1st of October 17, but I would have left it like that. Had I just waited for the time to come, I would have received 75, but I already had booked it at 70, which means that there is a total loss of 5 rupees per dollar thanks to this exchange rate. Okay, so of course the value of my hedged item is increasing on one hand, and the value of the hedging instrument is declining on the other hand, right? So when I have this kind of a scenario, I just need to do the accounting for both, and that is something which is referred to as the hedge accounting. Is it okay? Right? Now let's try to do some accounting on this part. Let's try to create some journal entries at this level and see to it if we can find some connect there. Let's do one thing. Let's begin with the hedged item. Okay, so given these rates, I'm saying on 1st of October 17, there is a receivables in my books, $100,000 at 68. So we are saying that this becomes 6.8 million. Of course, I'll book my sales accordingly. All right? Yep. I move on to 31st of December. I'm not doing the accounting here for the hedging instrument at this point in time. I move on to 31st of December. Of course, this receivable has increased, which means that I need to recognize a profit to the extent of 400,000, which is 72 minus 68 into 100,000. Right? I move further, 31st of March 18. 31st of March 18, my receivables have increased. And again, I recognize a profit, which is 300,000. 75 minus 72, that comes in my books here. Okay, so what I'm witnessing here, of course, is a total profit of 4 plus 3, that is 700,000. But yes, I could only have received a profit of 200,000. I sold at 68, I'm going to get 70. So my net profit is always 200,000 out of this entire game. So what I would want to do now is also do the accounting for my hedging instrument here. Okay, so when I do so, on this date, so this is my hedged item. As far as my hedging instrument is concerned, I do not do any accounting here whatsoever. I may not have paid anything at all to the bank to get into this arrangement, right? So as such, the value of the contract on this date is safely assumed to be nil. And of course, I don't do the accounting here, right? Moving a bit farther, I see that the contract would have been at 73, but I can only settle it for 70, which means that on each dollar I've made a loss of 3 rupees, right? So that means that I need to now recognize a loss and say that my contract is now a liability of 300,000. Okay, right? And finally, if I look at this value, 75, I booked at 70 originally. I would have got 75, which means a total loss of 500,000. I had already booked a loss of 3, so which means on this date, I need to recognize yet another additional loss of 200,000. Okay, so once I've done this, you will notice there is a 700,000 profit and there's a 500,000 loss coming into books. Effectively, I'm looking at a net gain of, let's say, 200,000. But then I need to settle these things now. Okay, how do I settle it? Of course, I would say on the same date, 31st of March 18, my receivables are standing at 68 plus 4 plus 3. So I would be settling my receivables at 7.5 million. Okay. I will be settling my contract, which is 500,000. There's a net liability of 500,000 that would also be settled. My bank will receive, of course, 7 million, which is my agreed rate with that banking company. Okay, right? So what we are saying is, under hedge accounting, we need to account for the hedged item, and we also need to account for the hedging instrument, right? So that's one basic understanding or an overview of hedge accounting that we wanted to discuss today in this particular lecture. There's a lot more complicated arena within this particular section of financial instruments. A lot to do, a lot to talk about, making it more complicated, making it more interesting, I would say, and deal with that part, right? So I would like to kind of hold on with my discussion at this point in time. We'll take more points with you later on and try to understand hedge accounting better with the next series of lectures, right? So that's it from my side. Do keep watching these lectures, and do subscribe to our channel, that is ABC Learning. Good day, good luck, and all the best. Bye.